Today's lecture will focus on inflation. We have discussed a bit about inflation, such as how to measure it before using the CPI or the GDP deflator. Remember, inflation is the increase in price level over time. Think back to the days where people could buy an ice cream for a couple cents, and today it's a couple dollars instead. That's an example of inflation. Deflation is going to be the decrease in the overall level of prices, so it's the opposite of inflation, almost like negative inflation. Hyperinflation is just going to be extremely high rates of inflation. Over the past 80 years, America has about 3.7% annual inflation compounded over so many years, and our prices are all of a sudden 18-fold to what they were before. Inflation is not inevitable. Milton Friedman, an economics Nobel Prize winner, is quoted as saying inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in the output. We're going to look into this statement. This statement has an assumption baked into it with large implications. One assumption is, like I said before, inflation is not inevitable. It can be prevented and even can be negative, such as deflation. There were many periods in the 19th century where we experienced this negative inflation, or we're just going to call it deflation. So when I say deflation, you can think of negative inflation, whatever helps you get the idea. Deflation is going to be lowering the overall price levels, so a negative inflation would also be lowering the price levels. Deflation may sound like a good thing. Lower price levels means our purchasing power increase and our dollars go further. But deflation can have negative impacts too. Today we're going to talk about inflation's costs and also deflation's cost. I'll give you a quick insight to why deflation might be a concern and has been a concern in our history. This is not very well known, but in the election of 1896, deflation was a major concern. In the preceding years, deflation had been a regular occurrence. In 1896, prices were 23% lower than in 1880. So through the past 16 years, prices have been dropping. Farmers had accumulated debt in the years prior to 1896. They wanted to open up farms because at the time farming was a very good business and pretty lucrative. So they would take out loans to start a farm, and they would see that the cost of corn was, say, $10 a bushel. Well, when the prices dropped, they had a harder time paying back their loans. So in 1896, they rallied to the politicians and stuff and saying, hey, we need to do something about this deflation rate and we need to fix it because I'm having trouble paying back these loans. I'm not making as much money as I thought I would. And remember, when we talked about our short run analysis, what happens when the price level is lower than what they expected, right? They're making less money than expected. Well, we know that the short run aggregate supply is going to shift to the left. And when it shifts to the left of the long run aggregate supply, we're going to be in a recession, right? Where the AD and the short run aggregate supply meet. But in the recent years, since the past 100 years, inflation has been much more normal. Deflation is not something that has occurred very much. It occurred during the Great Depression when we had the large shift in AD, which caused prices and quantity of output to drop. But in the past 10 years, inflation's been about 1.5%. It's pretty low. But in the 70s, it was closer to 8%. At some points, it was even up to like 10%. And in the decade of the 70s, our prices doubled. During the 70s, that was very troublesome to Americans. It was a huge issue. And Ronald Reagan, by the end of the 1970s, when he was campaigning against Jimmy Carter, said that that was one of Jimmy Carter's biggest failure was the high inflation rate. So this already represents a wide range of inflation rates. But if we look internationally, we can see a huge range of inflation rates. Japan had 1.2%, Mexico had 4.8%, Nigeria had 12%, Turkey had 15%, Argentina 32%, Zimbabwe had 24,000%. We're going to call this hyperinflation. But there are even more extreme examples. We'll go more into depth in a bit, but in Venezuela, they had 1.4 million% in 2018. That's about 2.6% inflation rate every day. That's the US annual inflation rate every single day. So this is some examples of inflation. But what determines how an economy experiences inflation? And if they do, by how much? We're going to go over the quantity theory of money. It is going to be summarized by one of the 10 principles of macroeconomics we talked about. It's basically prices rise when government prints too much money. It was first discussed by David Hume, an 18th century philosopher and economist, but was more recently championed by Milton Friedman, as I discussed earlier. The quantity theory of money is going to help us explain deflation, inflation, hyperinflation. It's going to be the whole shebang. So a little story about myself. Around 6 years ago when I started college, I was naive and young. I had a lot of strong beliefs about politics and economics, even though I really didn't have a clue about them. I made up my mind about these subjects before really considering them or breaking them down. It's kind of like the opposite of Socrates, or Plato's account of Socrates, when he spoke to the oracle Pythia, and she said that Socrates is the wisest, and Socrates said something along the lines of, if I'm the wisest, it's because I know that I know nothing, which I was the opposite, right? I was the unwise, believing that I knew something. So if you talked to me at the time, if you asked me, I would have been very strongly adamant. I firmly believe that inflation was wholly negative. It was a bad effect on the economy, while I thought deflation was wholly positive. I thought we should bring inflation as low as we can, get down to zero, and let's just focus on deflation consistently, because then consumers will be able to buy more things. While I don't think that this isn't an uncommon sentiment shared amongst the general public, it's not one that I think people should have. And this isn't, if you ever feel this way, it's not a bad thing, because you can always adapt your beliefs, adapt your mindset around these things, and really come out a better person. Luckily for me, my teachers set me on the right path and taught me economics proper. But not everybody gets that. Anyways, continuing on, we're going to go over the classical theory of inflation. Remember, when we're talking about the classical case, we're going to be talking about money neutrality in the long run, which is basically the quantity of money doesn't really matter, or the supply of money doesn't really matter, because if the money supply doubles, prices are just going to be double, and everything is going to be the same, just higher numbers. Why are we fine with spending a few dollars on ice cream when in the past it was so much cheaper? Do we like ice cream more than before and thus are willing to pay more for ice cream? Oh, sorry about that. Maybe we do like ice cream more. Maybe the enjoyment hasn't increased. But more than likely, people's enjoyment of ice cream has been the same. I bet they liked it in the 30s and the 50s just as much as we like it now. But the money to buy the ice cream has become less valuable, so you need more. Our money has decreased in value. We need more money to buy the same things that we used to buy. We need to spend $3 instead of a few cents. Well, interestingly, this observation doesn't say anything about ice cream. It just says something about money. Either the price levels increase or the value of our money decreases. You can think about it either way. In each case, each dollar buys a smaller quantity of goods and services. Let's look at a mathematical expression for this. Suppose P is the price level measured by the CPI or the GDP deflator. P is the number of dollars needed to buy a basket of goods and services. So if there's a basket, say of ice cream, chicken, burgers, and it costs $20, P is going to be 20. The quantity of goods and services that can be bought with $1 equals 1 over P. That is, the basket costs $20 and I only have $1. That $1 can buy me roughly 1/20th of the basket. So 1 over P is the value of money measured in goods and services. This is rather important because it's going to turn our nominal dollar, right, our nominal money into kind of like a real variable where our dollar is bought by a good and services. So an example of this to maybe help see it is, let's say an economy only has one good and we're just going to keep using ice cream in this case. So you can buy an ice cream cone for $2. P in this case is going to be 2. The value of the dollar will be 1/2, 1 over 2 of a cone. It's going to be half a cone. That kind of covers the mathematical expression. We'll see it later used on a graph. We already discussed money demand in a previous lecture. We're going to go a little bit, I think it was last lecture, but we're going to go a little bit more into it. Well, we're not going to go as into it, but one important variable to note in this case is that the price level is a big determinant in the quantity of money demanded. Higher prices means higher quantity of money demanded, right? You need more money to buy something that costs more in dollars amount. We talked about the short run determinants of equilibrium between money supplied and demanded, and at that time, right, the key variable was the interest rate. But in the long run, it's going to be simpler or easier. In the long run, the equilibrium will be the overall prices. If the price level is above the equilibrium, people will want more money than the Fed has created, so the price level must fall to balance supply and demand. If it's below the equilibrium price, we'll want to hold less money than the Fed created, and the price level must rise to balance supply and demand. We discussed before, money supply is determined by the Fed and the banking system. We don't need to go over it again. So here's this graph. On the left side of the y-axis, we have value of money, 1 over P, and it is increasing as a traditional y-axis. So as the value of money increases, we need less of it. So the quantity is going to be smaller. The value of money increases, lower quantity demanded. Value of money decreases, higher quantity demanded. Lower value, higher quantity. On the right-hand y-axis, we have the price level. Economists are a little bit tricky, and we like to keep our money demand negative slope, right? We want to keep it. So we have a increasing price level, but in like a descending order. So as you go lower, the price level increases. So as you can see here, we start at 1 at the top, and then as we move down, we go 2 and then 4. This also makes sense. As the price level increases, as we go down, we need a higher quantity of money demanded. As the price level increases, as the price level decreases, as we go up, see, even I'm getting tripped up by it. As the price level decreases and we go up the y-axis, we need less quantity of money demanded. So we'll be around here at this point. Where money demand and money supply meet, that's going to be the equilibrium. So let's talk about the effects of a monetary injection. If the Fed increases money supply, what's going to happen? Let's look at the money supply shifting to the right. So it's going to be on this graph, but just imagine money supply shifting to the right. I'm going to show you in a second to later, but if the Fed increases the money supply, we already discussed how the Fed does it, right? They can print bills, they can do the open market purchases. We're gonna create a new equilibrium, and the supply of money is going to shift to the right. So here we can see this, right? We went from this blue line, this MS1, to this MS2. The price level increase, that's our inflation, right? As money supply increases, we have inflation. So we're going from A to B, which is an increase in the price level from 2 to 4. Or the value of our money decreases. This is the quantitative theory of money. To put it plainly, the quantity of money available in the economy determines the value of money. And the growth in the quantity of money is going to be the primary cause of inflation. It comes back to scarcity of the money. The less money there is, the harder it is to get. It's going to make it worth more if you increase the amount. And it becomes, the less money there is, the harder it is, making it worth more. But, if you increase the money, it's going to be easier to get, and the value of money is going to drop. In other words, inflation occurs. So if you increase the money, inflation occurs. This is the same with any object, by the way. I'm quite the Batman fan, you may have noticed, and I like to use this as my personal example when thinking or discussing these ideas. And I even asked you guys a question about this on one of the homeworks. Well, sort of. I brought up this same idea. Take Detective Comics issue number 27, Batman's first appearance. It was printed in 1939, and while it is a very special comic book, if you have read it, which I suggest you do, you can do it online for free. That's how I did it. It isn't anything super compelling it's not even terrific writing. Most of what we associate with Batman wasn't even in the book yet. Gordon was there, yeah, sure. He was Bruce Wayne's friend. But there was no Robin, there's no Batcave. I don't even think there was a Batmobile. And his costume was radically different, even maybe silly. But in 2010, it sold for $1 million at auction. It's because it's quite a rare book. It was made in 1939, not many of them are around. Especially at that time when comics were kind of just considered to be not as rare as like books or something. They didn't really keep them in good condition. So if you have one in good condition, that's even more rare. Most of them are in bad condition. It's been 80 years, over 80 years since it was printed. If, however, let's just hypothetically say every single person on the planet walked into their attic and found a mint Detective Comics issue number 27 from 1939, how much would the book cost? It wouldn't cost very much at all. Everyone who wants one already has one. And the people who don't want theirs would even have a hard time selling theirs. How much are they going to sell it for? I already have one, so it's not like the incentive for me to buy one is very high. I can already read one without having to buy theirs. I hope this example demonstrates how scarcity and prices are related, and similarly, by the transitive property, how the scarcity of money and the value of money are related. When it becomes less scarce, right, when there becomes an abundance of money, the value of money is going to drop. Or in other words, inflation. If the money supply increases, the value of the money is going to decrease and the price level is going to increase. We already talked about the quantity theory of money, growth rate and the quantity of money variable determines the inflation rate. Let's talk about the adjustment process. To explain the adjustment process, refer to the short-run economic fluctuations we already kind of discussed. When the Fed prints more money, people try to drop off this excess money that they don't want or don't need. Remember, they take it to banks or they buy bonds, and the interest rate is going to adjust. It's going to change, pushing the quantity demanded of money and supply to equilibrium. If the Fed increases money, in this case the interest rate, and it's going to increase the demand for goods and services, right? The economy's ability to produce hasn't changed. The economy's output is determined by labor, physical capital, human capital, and natural resources and technological knowledge. So that's going to be constant, the output. And that's not going to be altered by the injection of money because those are real variables. The shift in AD pushes the price levels up, and if the price levels rise, the demand for money rises, and this is why it goes to equilibrium. So let's actually look back here, right? The money supply increases, and if you can picture the AD shift to the right, that's going to push the price levels up, right? Remember, if the AD shifts to the right, price levels rise, so then we have the price level rising here. And what does that do to the quantity demanded for money, right? The quantity demanded money actually rose from A to B, right? We went from this level of quantity demanded money to this level of quantity of money demanded. So in this way, you can see how it comes into equilibrium. You can see the adjustment process. It's through the shift of the AD that the quantity, or it's the quantity of money demanded increased. So we're nominal variables, real variables, classical dichotomy. So what we're going to discuss here is the classical dichotomy and the monetary neutrality. We discussed it when we first spoke about aggregate demand and aggregate supply. Early economic thinkers divided variables into two categories, real and nominal variables. We're just going to review it here. Nominal variables are measured in monetary units, and real variables are measured in physical units. Let's think of a farmer. A farmer's income is a nominal variable. It's measured in dollars. And the quantity of corn they produced, however, is going to be a real variable because it's measured in bushels. This is the classical dichotomy. Classical meaning early economic thinkers in this case. And dichotomy is a division into two groups. Can price be a real and nominal variable? Well, price is measured in dollars, so it's definitely a nominal variable. But could it be a real variable too? If we use relative price, then absolutely. If I say a pair of boots is worth 30 ice creams, then the price of boots in terms of ice cream would be a real variable. There's no dollar signs there. If the ice creams cost $2 and a pair of boots is worth 30 ice creams, then a pair of boots is going to be worth $60 in this case. But even if the price of ice cream was $40, the pair of boots is going to be, what, $1,200? So you can see that the money in this case, the price doesn't actually matter. And that makes it a real variable. This lesson that we just learned means we can calculate the real wage, which is going to be the dollar wage adjusted for inflation. It's a real variable describing the rate at which people exchange goods and services for a unit of their labor. That's the real wage. We don't have to say that wages are in nominal variables. We can put them in real terms. Or another example is the real interest rate. It's going to be a real variable that represents the rate at which people exchange goods and services today for goods and services in the future, right? Because I'm sacrificing what I could consume today. I'm putting it into a savings account. I could take that money and buy whatever I want right now. I'm sacrificing the current ability of consumption so that I could save it for later and consume in the future. So it's the trade-off between goods and services today for goods and services in the future. I hope that's clear. It's actually really important in further future classes. Why is this important? Well, recall that nominal variables are affected by the monetary system, and real variables are not. Also recall, monetary neutrality says that if money supply doubles, then prices just double and everything's the same, but the numbers are bigger. Is this principle realistic, though? Well, we know that it isn't. If you recall from our short-run analysis of the aggregate supply and aggregate demand, it actually can affect real variables, at least in the short run. You know, let's think of it as a ruler or a common yardstick, right? Okay, so let's think of the length of a yard. Let's just say that the length of a yard suddenly increases or decreases from 36 inches to 18 inches in the long run. It's not going to matter. But in the short run, people are going to have to adjust to the new meaning of a yard. They're going to be discussing, like, oh, a yard, and they're going to be like, oh, 18 inches. They're like, no, 36 inches. So it's going to cause a lot of confusion in the short run. In the long run, people are going to be like, it's fine. You know, a yard is now 18 inches. It's just a new definition or whatever. I know it's a bit silly, but I'm using this example because remember that money can be used as a unit of an account or as a yardstick. So it's gonna help. I hope it helps like transition money onto like the confusion that people are gonna have when you just suddenly change how much money is worth or how much value a dollar has. And empirically, if we look at the data, this concept seems to be true. In the short run, monetary changes are going to change real variables, and in the long run, monetary changes have negligible effects on real variables, but it does have significant effect on nominal variables, like the price level. So if I increase money supply in the long run, it's going to have significant effects on nominal variables, such as the price level. Next, we're going to talk about the velocity of money, and we'll also discuss the quantity equation, but first we need to go over the velocity of money. This is how often money changes hands. When we talked about the money supply previously, it may have seemed like money was static. It's either being printed at the Fed, dropped off at banks, or at somebody's house. But money is, as you know, quite often exchanged. This rate of exchange is we'll call the velocity of money, or how quickly money is traded for goods and services. So a high velocity means that money is exchanged quickly and often, and a low velocity means that it is slow to transfer hands, or it doesn't get moved around very much. We're just going to do a quick little example. A hypothetical economy spends $1,000 a year on pizza, and a pizza costs $10. The money supply only has $50. How can the economy spend $1,000 on pizza if the money supply is only $50? Well, if each dollar in the money supply changes hands 20 times per year, we have our $1,000. So V is going to represent the velocity of money, the rate at which money changes hands. P is the price level, M is the money supply or the quantity of money, and Y is the real output, real GDP in this case. We're going to go into our quantity equation. So from before, here you can see V is equal to P times X, or times Y over M, which is the price times the output is the total amount of money spent. And that's going to be divided by the money supply. It's going to be equal how fast money changes hands. If we rearrange this equation right here, if we multiply M by both sides, we're going to arrive at this equation. The money supply, or the quantity of money, times the velocity of money is going to be equal to how much money we spend on goods and services. The price of the goods and services times the number of goods and services there are, the real GDP. These two must be equal. Just like in our example with the pizza, our money supply was 50, the price of pizza was 10, and our V was 20, so if we calculate it all out, we would have a number for Y, how many pizzas we created. But we spent $1,000 on pizza, so in that case, you could say P times Y is equal to 1,000, M is equal to 50, divide 1,000, the P and the Y, by 50, and then V is going to be equal to, we said that was 20. So that's how our equation works, it's how it's formulated. And also, we can now see a relationship between the money supply, velocity of money, the prices, and real output. So if there's an increase in the money supply, let's say the Fed increases the money supply, M goes up, one of three things has to happen in order to keep this equation true. V must go down, so money is slow to exchange hands all of a sudden, or P could increase, or Y could increase, or it could be a combination of all three. Who knows? You'd have to look at the data and go through it. But remember that Y is constant. It's not altered by the changes or the alterations in the money supply. So this Y here is going to be constant, which really means that if the money supply increases, it's either going to be velocity of money or it's the price level. We're going to look at the velocity of money. We can actually calculate it, and we have. When we look at this graph, right, we see that what is this? Red is the nominal GDP, M2 is the money supply, and this blue line at the bottom is velocity. So even though nominal GDP has been increasing and M2 has been increasing, the velocity has stayed constant. This is interesting. So if we look back into our equation, V is constant, Y is constant. So these two don't really change. You could put a 1 there if that helps you think about this. M is equal to P. If M increases, P has to increase because the real GDP is determined by factors that aren't the money, such as capital, human capital, physical capital, natural resources, technology, and the amount of labor, right? And V from our graph is constant. Then an increase in the money supply is going to have to increase the price level in order for this quantity equation to remain equivalent to each other. Both sides have to be equivalent. This just kind of explains what I discussed just now. Velocity of money is stable from this graph. Changes in quantity of money is going to affect prices, not really Y, because if you look at number 3, it says it's primarily determined by factor supplies, not money. Which means that if M increases, it's going to be P. P has to change in order to keep the equation similar. Let's talk about hyperinflation for a little bit. Hyperinflation is going to be anything that exceeds 50% per month, which is more than the increase in prices. It's going to be like 100-fold over the course of a year, so it's going to have pretty big changes by the end of 12 months. Is there a graph here? Okay, so we are going to look at these 4 graphs of hyperinflation. This one's Australia from 1921 to about 1925. You can see that the money supply and the price level are highly related or correlated. They move together. As the central bank increases the money supply, the price level follows. And here you can see the price level over just 4 years, what was that? 100 times what it was. So that's huge. It's massive. That's huge hyperinflation. This isn't even the worst case. We have 3 more to look at. Hungary, which from around the same time period followed similar suit, increasing the money supply. Price level increased as well with it, and they almost got it to 100,000. Big, big effects. In Germany, the worst case we've ever seen was from 1921 to, well, I shouldn't say, I actually don't know if it's the worst case, but it's definitely the worst case probably recorded. From 1921 to 1925, you can see the price level just shoot. What is this? 10. So this is hundreds, thousands, millions, billion, trillions. So they were over 4 years. Their money is absolutely insane. How much their money just increased in just 4 years. And Poland, much more tame version, still quite huge, right? In the same 4 years, a million or 1,000 times as big. So all these cases are just huge cases. And in each one, we can see that the money supply and the inflation followed really closely. And I think hyperinflation demonstrates the relationship between the money supply and the price level or inflation very well. Next, we're going to talk about the inflation tax. The inflation tax is a very subtle way for the government to tax their citizens. I say tax because it's not like they hand you a bill and say you owe us this much. It's because taxes reduce the citizen's income or wealth and increases the government's revenue. How does it do this? The government prints money and they use that money for their spending. And they raise revenue from printing the money, but the inflation, right, from printing money is going to decrease the value of our dollars, which is going to mean we have less wealth. Or in other words, we lost money, the government gained money, they gained revenue, we lost money. It's kind of like a tax, which is what we're going to call it an inflation tax, but it's really only going to affect the people who hold money. If I have money in interest-bearing assets and things like that, or let's say I have money in all houses, then this inflation tax isn't really going to affect me. So in each one of these 4 cases of hyperinflation, the reason why these countries were printing so much money was so that they could basically have this inflation tax. They could increase money, increase their government spending, and provide whatever services the government were providing at the time. But you can see the inflation effects can have drastic consequences. So like this inflation trap or inflation tax for countries can be quite the trap. Let's go into the Fisher effect. The Fisher effect was named after Irving Fisher. He studied the inflation rate and the nominal interest rate. He developed the relationship between these two. In the long run, money supply should not have effect on real variables. Remember the monetary neutrality and its hold on the long run. But let's think back to the equation real interest rate is equal to nominal interest rate minus the inflation. You can rearrange it if you want to have the nominal interest rate equal real interest rate plus the inflation rate. But focus on real interest rate equals nominal interest rate minus inflation rate. If the money supply increases, it shouldn't affect the real interest rate. So that should be constant. But it is going to increase inflation. We know it affects inflation. It shouldn't increase real interest rate. But if it increases inflation, in order to keep this equation the same, in order to keep the real interest rate the same, nominal interest rate has to rise by just the same amount as inflation rate. So if inflation rate rises 2% and the real interest rate is 4%, in order to keep the real interest rate at 4%, nominal interest rate must also raise by 2%. We can look at a few graphs where it shows the nominal and the inflation rate rising and falling together. The two are highly correlated, and that's because of the equation we just studied or just went over. When the money supply increases, inflation rises. In order to keep the real interest rate the same, the nominal interest must rise. So think here, if the inflation rate is between 12 and 15% at this period, what may have happened? What can we think possibly happened? Maybe the money supply increased during these periods, so inflation rose. Inflation rose, so in order to keep the real interest rate the same, nominal interest rate must have rose or had to rise with it. That covers basically the Fisher effect. The long results is going to be higher inflation rate, higher nominal interest rate, but the real interest rate remains the same. So the monetary neutrality holds true in the long run still. Let's go over our last concept of the lecture today. It's pretty long, but it's going to be the cost of inflation, and we're also going to cover the cost of deflation at the end. There was a study that once found inflation to be the #1 economic term mentioned in newspapers all across the country. It beat out unemployment, which means newspapers and very likely the public view of inflation is that inflation is one of the most important economic variables to watch out for, beating out unemployment, which I think says quite a bit. If you ask a random stranger why inflation is bad, or, ask a young, naive Austin just starting college, I would say that inflation was bad because my purchasing power and the purchasing power of consumers has been robbed. We lost our hard-earned dollars, the value of our hard-earned dollars. It may seem that inflation directly lowers living standards. I can't buy as much because of inflation. The value of my dollars decreased. I have to spend more of my dollars to receive the same standard of living. So it may seem that inflation directly decreases living standards. But this does ignore monetary neutrality, which we have discussed. Inflation itself does not reduce people's real purchasing power. If you think about it, the people's real wage doesn't actually change, or shouldn't change, because their nominal wages should just increase. This makes sense when inflation is included in wage contracts, or if the employees renegotiate for higher wages, and they include the inflation, so it's like the cost of living adjustment, right? So there are going to be a couple other reasons why inflation might be a problem. Now, it's not that this isn't or couldn't be in effect, right? If for some reason wages are stagnant and aren't changing as fast as inflation, then that could be a problem. And in this case, inflation would really rob consumers of their purchasing power and directly affect or lower living standards. However, most of the time, people can and do fight for cost of living adjustments. And also in a lot of contracts, or even in union contracts and such, they will have automatic inflation adjustment rates. So next we're going to be going over shoe-leather costs. Recall the inflation tax. If the government prints too much money, there's a tax to the people in a sense. It isn't necessarily a loss to the economy, even though it may be a loss to the specific individual, but it is a transfer of resources. They print money, they gain revenue, we lose money, and like taxes, it's going to cause dead weight loss because people are going to behave differently and they're going to waste resources avoiding the tax. And how do you avoid this inflation tax? Well, one way is to hold less money. Instead of holding $200 for the month, you take it out at the beginning of the month, $200. Instead of doing that, we can instead take out $50 on the first week and each subsequent week. This way, more of my money stays in interest-bearing assets for longer periods. But walking to the bank each week is going to wear down the leather on my shoe, and I'm going to have to pay to fix it. In other words, the shoe leather cost. I know it sounds silly and insignificant. You can think of maybe like car depreciation or gasoline to drive to the bank. But in a country with hyperinflation, this is actually going to be a big deal. It's going to be a substantial thing. Here in America, right, it might be a small worry about the depreciation of your shoes or depreciation of the car to avoid 2% inflation over a year. But when the inflation rate is 10,000% a year, that might change something. There's a story from a teacher in Bolivia. His name was Edgar Miranda, and his pay was 25 million pesos. Every hour after he got paid, the pesos he just received dropped in value. This put Edgar in a state of like a race against time, because he needs to exchange his pesos as fast as he can for maybe black market dollars or maybe goods and services so that he doesn't lose out on his pay or his salary. So his wife, after the payment, rushes to the market and buys a month's supply of rice and noodles. And he maybe tries to go and buy some other goods that he can then spend on. Maybe he buys a bunch of cigarettes so that he can trade cigarettes later. So it kind of becomes a bartering system, right? That becomes a bigger problem in the future because then you have to deal with the double coincidence of needs and wants, and it basically makes trade more difficult. And it's also he's gonna have to expend a lot of effort every single time there's a pay, and he's gonna have to expend effort on buying those goods and trading those goods for other goods and things like that. That is an example of the shoe leather cost, but in a real sense. And what happens if he doesn't exchange his pesos? And the first day, his pesos are worth 50 US dollars. Those 25 million pesos are worth 50 American dollars. But just days later, maybe a week later, his same salary is going to be worth $27. So his purchasing power decreased substantially. And then he has to waste all of these effort and resources to trade his pesos as fast as he can to reduce the hurt and the pain of the hyperinflation that he was experiencing. So the effort that he expended would be an example of a shoe leather cost. Next is menu cost. It's going to be similar to the menu cost when we were studying sticky price theory. They're going to show up in this case as well. In America, prices, like firms, they did a survey a few years back. Prices change about once every year. When inflation occurs, the cost for businesses is going to increase. And the firm fronts that loss until they can change their prices. So until they change their menus. The delay in changing their prices comes from wanting to avoid the menu cost. But in countries with hyperinflation, changing prices yearly is impractical. The menu costs are usually lower than the inflation costs. So you may need to change prices daily, or even more often than that, maybe every 12 hours, every 6 hours, just to keep up with all the other prices. This is going to expend resources and effort from firms wasting their money and their time. Just think of a merchant who's trying to sell fish. He spends all his time increasing the prices on his fish and looking up what the inflation rate is and things like that, that he's not making as much fish and he can't sell as much fish. That's an example of why it's being inefficient and why it's wasting resources. He's wasting his labor on changing these prices because inflation is so high. This next cost of inflation is going to be a little different. It's going to be the relative price variability and the misallocation of resources. If a company changes prices in January and keeps them constant for a year, because they change prices about once every year, the relative price compared to the other goods in the economy is highest in January, because he just changed his prices. And as inflation happens and prices rise over the year, the relative price of this company's goods are lower. So what do I mean? Let's say all goods are worth $1. This company is changing its price because inflation is occurring. He switches it to $2. So relative to all the other goods, his product is very expensive. But as inflation occurs throughout the year, let's say all those other companies jump to $3. At the end of the year, that company's relative price, because his is $2, is lower than all the other companies. Why is this important? Well, consumers decide what to buy by comparing goods and services and determining where to allocate their resources. They determine how scarce factors of productions are allocated among industries and firms. When inflation distorts the relative price, consumer decisions are distorted and markets are less able to allocate resources effectively or to their best use. That covers relative price variability and the misallocation of resources. Next, we're going to talk about the inflation-induced tax distortions. Taxes generally cause people to alter their behavior and lead to a less efficient allocation of resources. This is even more so in the presence of taxes. Lawmakers often fail to account for inflation when writing tax laws. Let's think about capital tax gains. If you invest $10 into a stock in 1974, and that stock rose to $140 in 2018, the gain you are being taxed on will be $130 or $130. A capital gains tax is a tax on what you gain during the period of your investment, but it's going to fail to take into account how much the value of the $10 was in 1974. Because in 1974, that $10, if you think about it in 2018 value of money or 2018 dollars, that $10 is worth $50. So your actual gain wasn't $130. It didn't go from 10 to 140. It went from 50 to 140. So your actual gain was $90, not $130. But you're being taxed on $130, meaning that the investment looks worse, making it harder for people to efficiently allocate their resources. That explains inflation-induced tax distortions. Next, we're going to talk about, well, if they are being inefficient about their investment processes, right, it's going to discourage people from saving because investing looks worse than it actually is, or than it should be. Not that it is, because it is actually worse than it should be. Going to move on from that, we're going to talk about confusion and inconvenience. This kind of has to do with the unit of account or the yardstick for the money supply. Like we discussed before, unexpected inflation is going to confuse people or inconvenience people. We already discussed how this may change the short run, and it's going to be really hard to measure this cost, meaning it's hard to account for confusion and inconvenience. There's no way to really, capture how confused people are when the money supply increases, inflation increases. It's also going to make it harder to predict the future. How do you make decisions when you can't anticipate the future? What saving decisions do you make when the inflation is currently 10%, but next year it could be 100%? It can be hard to know what the optimal decision is and where to put your money and where to save. This may also be, as we discussed a little bit before, if money is what we use as a yardstick for making transactions, and if the value of money suddenly changes, our yardstick suddenly changes. It's just like the case of the ruler. We went from 36 inches to 18 inches. All of a sudden, it's hard to measure with a yard. Next, we're going to talk about a special cost of inflation. It's an arbitrary redistribution of wealth. It has to do with unexpected inflation. This is the most important thing. Think about debtors and creditors. It's going to redistribute the wealth between creditors and debtors arbitrarily, depending on whether it's inflation or deflation or how much inflation it is. It's not through merit or not by need. One wins out and the other loses. So if there's a small and predictable amount, oh wait, no, this is deflation. We're still on inflation. So if I take out a loan at a bank for $20,000 with an interest rate of 7%, that's due in 10 years, then in 10 years I'm going to owe $40,000, roughly. Well, how does inflation factor into this? If I'm lucky, because I just went into $20,000 debt and I'm going to owe $40,000 in 10 years, if I'm really lucky, hyperinflation is going to happen, which I know sounds silly. But if I'm making $25 million, just like Edgar Miranda was, every payday, then paying back the $40,000 loan is going to be a drop in the bucket. That's going to be 1 month pay. It's not even going to be that much of my pay. It's going to be super easy. So in this sense, the redistribution of wealth went from the creditors to me, the debtor. I arbitrarily gained money in the present, and in the future I had to pay back less money. If deflation occurs, however, during that period of the loan, it's going to be harder for me to pay back. Think of the farmers that I used in the very beginning. Their prices that they expected were lower than what they thought they were going to be. So then they had a hard time paying back the loans. I'm not making as much money as I thought I was going to be, so this loan is going to be particularly painful to me. And this redistribution of wealth from creditors and debtors is not because, again, of merit or need. It's just going to redistribute resources, and it's not going to be efficient. It's going to be inefficient, and it's going to waste resources that way. If inflation is known, then it's going to be easy to include into the contract. If it's predictable, it's not a big deal. But because inflation is volatile and uncertain, it could be a problem in the contract. Now, most contracts and loans and things, they usually have like a thing where they see, oh, hey, the CPI was this last year, so we're going to adjust the contract or the interest rate just a little bit. So that way it reflects more of like the real interest rate. But in either case, it's still hard for, and I mean, even most people don't think about the inflation rate when signing contracts. They don't know if they're going to be owing more or less. Inflation's bad, deflation may be worse. Milton Friedman said that, he argued that maybe a small amount in deflation may be desirable because it would reduce nominal interest rates and it's going to reduce the cost of holding money. But deflation is still going to have menu costs, for example. Firms are still going to try to delay the costs of changing menus, except in this case, instead of the cost being levied on the firms, it's going to be levied on the consumers. But the real issue with deflation is the unpredictability of deflation. It's often less predictable than inflation. It's even more volatile, and you never know when it's going to happen. And it shifts the distribution of wealth from debtors to creditors. The people taking on the loan are often poorer than the creditors, right? The reason I took out a loan is because I can't afford to open up a farm or open up a store, buy a car, etc. And because I'm poorer, this deflation is going to be extra painful. I'm already in a bad place. I take on a loan. In the future, prices are worse, and I become even worse off than where I was. So deflation could be a problem for the poor and for people who take on loans. People who take on loan, typically poorer people. Another potential problem is that deflation or falling prices is usually caused by monetary contraction, which creates an 80 shift to the left, or it's going to decrease aggregate demand. And when aggregate demand decreases, prices drop, quantity produced drops in the short run, but not in the long run. Long run, quantity produced is the same. So it's gonna decrease incomes. Incomes are gonna fall, and unemployment is going to rise. In other words, deflation is often a symptom of deeper economic problems. Aggregate demand decreasing. So, in conclusion, we could talk a little bit about the Wizard of Oz. This kind of has to do with the 1880s and the farmers I was kind of discussing. So there's a Western journalist who wrote The Wizard of Oz. He wrote it in 1900, and some people have said that this might be an allegory about the U.S. monetary policy in the late 19th century. So in the 1880s, and the farmers were debtors, bankers in the East were creditors. They wanted to increase the money supply, basically causing inflation, so that these farmers would have an easier time paying back these loans. Now, in The Wizard of Oz, these farmers wanted to coin silver at the time, because during this time, our money was based off the gold standard, so it was all basically determined how much gold. The farmers wanted to be the gold and silver, so the government would start minting silver as well, which would increase the money supply. If it increased the money supply, that's going to increase the price level, it's going to increase inflation. When inflation occurs, it's going to shift from the creditors to the creditors to the debtors, right? So the debtors are going to have an easier time paying off their loans, and basically it's going to help the farmers in this case. The author was L. Frank Baum. The main thing to worry about in this is this last statement here. Dorothy finds her way home, not by just following the yellow brick road, which is, I guess, gold, but through the magical power of her silver slippers. In the movie, I know it's the red slippers or the ruby slippers, but the reason in the movie that they were red was because at the time they wanted to show off the technology that they had, but in actuality, in the book, they were silver slippers. So in this allegory for the book, the silver slippers, or minting silver, is going to help save the farmer, or the standard American at the time, Dorothy. That concludes this lecture. So we covered the quantity theory of money. That's going to be extremely important. We covered inflation costs. We covered money growth, money supply. But remember, the costs of inflation are generally subtle, like the inflation tax, the shoe-leather cost, menu costs. These aren't something that we see on an everyday level or on a grand scale. And are these costs large? Well, all economists believe that these costs are going to be extremely large in the hyperinflation. I hope I made my case in that sense. Hyperinflation is extremely bad for an economy and is going to basically damage it in a lot of cases almost beyond repair. They usually need some sort of restructuring of the government or the economy to really succeed. This can be done. Obviously, Germany did extremely well, even though they had the worst case. But what about the moderate inflation rates? How do these costs affect in countries with moderate inflation rates? Well, honestly, the debate's still open about these. They definitely affect us to some degree, whether it's a problem or not, whether inflation is an actual problem. Maybe not. Maybe in this case, maybe it's better to have inflation than deflation. Thank you. That concludes the lecture.